As you've heard from us already, 2022 was a very difficult year for financial markets. Before we dive into why that was the case, I want to offer some positivity. It's now been 3 years since the onset of COVID. For myself, 2022 felt like the first real stretch of getting comfortable with the things that have changed and enjoying those things that have returned to normal. Think of events like weddings, birthday parties, or even a team bonding afternoon at Topgolf. Those things were missed, and it's good to have them back, even if financial markets didn't add to the celebration this year. Still, we start with more positives. Returns were in the green for both fixed income and equities in Q4, with gains largely coming in October and November. This positivity was seen after U.S. inflation data came in lower than expected in October, creating a growing belief amongst investors that inflation had peaked and that central banks would soon pivot to be less aggressive in their efforts to control inflation. Importantly, this reflects what we saw throughout most of 2022. Markets closely following every inflation report and Fed meeting, with volatile moves in asset prices occurring as expectations rapidly adjusted. As we can see in this slide, inflation expectations did peak in April and have steadily declined throughout the second half of the year. Looking now at equities in Q4, international stocks were very strong, with the MSCI EAFE index up a sharp 17.3% on the quarter. The MSCI Emerging Markets Index was also strong at plus 9.5% for the past 3 months. International markets have less of the mega-cap technology names than U.S. indexes, and those names like Facebook, Tesla, and Amazon were under pressure in 2022. Still, the S&P 500 closed the fourth quarter plus 7.5%, below international markets, but still a very positive quarter. Dave and I will discuss the volatility in the large cap sector later in our discussion. Before we move on to bonds, I want to show a chart of the US dollar to put in perspective the moves in international stocks. From January to October of 2022, the dollar rose 16% against a basket of foreign currencies, which is a very sharp move. Dollar strength was driven by the Fed raising rates earlier and faster than other global central banks. However, with inflation expectations seemingly peaking, the dollar fell 7.7% in the fourth quarter. Now let's turn to fixed income markets, starting with the yield curve. This chart shows the yield curve as it started in January, where it was at the midpoint in July, and finally where it stood at the end of the year. Obviously, we see that the yield curve is quite a bit higher than where we started 2022. And of course, it's inverted. You can see the beginning of the year at the bottom in blue, mid-year in green, and the end of the year at the top in orange. Let's think about what occurred throughout the year to cause this. The Federal Reserve raised rates 425 basis points in one of the sharpest moves in history. This was to address the much stronger than expected inflation. Remember, 1 year ago in December 2021, the futures market priced in rate hikes of 50 basis points for all of 2022. And as I mentioned, we ended the year with 425. While the Fed continued to hike in Q4, including 50 basis points in December, 10-year yields peaked in October near 4.2%. They closed the year down near 3.8% and were down to 3.6% by early January. This shift lower in the yield curve has been positive for bond returns. Indeed, the fourth quarter was strong as the Bloomberg U.S. Aggregate Index was up 1.9%, erasing some of the sharp losses seen in the first 3 quarters of 2022. Meanwhile, the Global Aggregate Bond Index was up 4.5% as foreign currency bonds benefited from the fall in the dollar. Looking at 2022 full-year returns, well, they are ugly. For stocks, we see weakness everywhere. The MSCI Emerging Markets Index down 20%, the S&P 500 was down 18%, and the EAFE Index down 14%. There are also some interesting style trends to note. Looking at growth versus value in the U.S., the S&P 500 Growth Index fell by 30% on the year, weighed by sharp losses in tech names like Google and Nvidia. Meanwhile, the S&P 500 Value Index fell just 7.4% in 2022. Investors last year favored companies with less growth but more predictable earnings, such as those in the energy sector, which was up over 60% on the year. This style trend does make sense. Growth names are less attractive when rates are higher. It begs the question, are we in a new era with higher inflation and higher rates? This is something we will continue to review in 2023. In fixed income, the Bloomberg aggregate closed the year down 13%, marking the worst bond returns in 200 years. The volatility is really interesting to note for a couple of reasons. First, stocks and bonds rarely fall in tandem. These assets tend to be uncorrelated or negatively correlated, meaning they rarely move in the same direction. This is why 60-40 portfolios have been so popular historically, but last year that correlation turned positive. Now that bond markets have quickly replaced inflation risks, we can expect a more stable yield curve and bond prices in 2023 versus 2022. This suggests that we will return to a more traditional neutral relationship with stocks. The other interesting thing to note here is valuations. If one has to find a silver lining in this bear market, it is that assets generally have fallen to more attractive levels based on historic metrics. Looking at global equities, this chart shows 5 major markets. The gray bar represents the 25-year average for PE ratios, the purple bar the 25-year average, and the blue diamond is current levels. U.S. stocks are near the 25-year averages after starting 2022 at very high levels. International stocks are all below 25-year averages, with Japan and Europe at very low levels. While calling the bottom to bear markets is a fool's errand, patient investors will see current levels as more attractive than a year ago, and cheap when looking at Europe and Japan. In fixed income, valuations are also fairly attractive versus their 10-year averages. This chart shows 12 fixed income sectors looking at yield to worst. Yield to worst is a measure of the lowest possible yield for a bond held to maturity without default. The dark blue diamond shows that in nearly every sector, current yields are high versus recent averages. This means bonds are again offering compelling yields and should offer ballast to a traditional balanced portfolio. Let me close now with a few thoughts. We've been through a rough year for investors, undoubtedly, but we've also learned a few things. It is likely that the market will now shift its focus from inflation, which should no longer be a surprise for investors, and the shift will be to growth, both economic and earnings growth, which we will continue to watch closely. Historically, years following bear markets are good for investors, and it's rare to see 2 negative years in a row. As noted earlier, bonds have been repriced and again are offering yield, and that should translate to ballast in a balanced portfolio. It is unlikely that the next decade will look like the previous decade, as leadership, particularly in stock sectors and frequently in countries, has always rotated. Wespath builds globally balanced and diversified portfolios that will allow investors to take advantage of the next market leaders and avoid the highs and lows of being overly concentrated. We continue to believe that investors should stay the course, remain invested, and focus on long-term results.